The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks, to the Commodity Hour here at TFNN, and we're going to start the show today with live cattle. This chart was actually brought to our attention a long time ago, way back in November, by our friend Rich Anderson and also by one of our good friends in the den, Mr. Z. We were looking at this top up here at 171. And as you can see, we've now completed the first major ABCD correction in cattle, I think in the last 9 months. That's the really first clear one that we've had. We've had a few corrections, but none of them in the ABCD variety. So it was a perfect move. We went from 172.5 down to 155 up to the 61% retracement at 167. And then we completed the ABC D to the downside at 151. So cattle should be getting ready to rally. We rallied the first few days a little bit anyway, which is a good start. Now, as most of you are aware, we're having a lot of things happening in the markets today, and they're quite important, of course, as they always are. But at the break, we're going to have a special guest on that we've had before. Ed Carlson from the Seattle Market Technicians Association is going to be on. Ed's specialty is the work of George Lindsay, the man who founded the Three Peaks in the Dome House, which is also a fabulous pattern, but it's not seen very often. So he'll be our guest at the half hour. Very, very learned fellow and quite nice, and I think we'll learn a lot from him. Now, the next one I wanted to talk about here is the E-mini S&P, because today's high was exactly a 61% retracement of the high that we made back in late December. It was also a 786 retracement of the high from January 3rd. So as long as we don't get above the 2050 area, this is nothing more than a 4-day rally. What's interesting about this is that the last 4-day rally that we had transcended from 1980 up to 2060. It was 80 points, correct? And we had a rally today from the low few days ago at 2071. If you add the 80 points to that, that's going to take you to right near the high of the day in the S&P, which tells us we've had 2 equal rallies. One of them took 4 days, and guess what, folks? This one is taking 4 days. We have a lot of harmony in the market here with this S&P lining up. In fact, this is really an interesting thing to look at. Most people don't really watch the repetitions in the market, but I think we should show this to you because the market never really changes. It just repeats itself from one phase to the other. And what I'm going to do here is I'm going to put both of these swings in here so that you can actually see them, the fact that they were nearly perfect. And it's a very interesting thing to have happen, because when it comes in with the Fibonacci ratios like we have now, it even means even more. So you'll be able to see that if you go into Tiger TV, that the move from January the 6th up into the 9th took 4 days, and the move from the 16th to where we are now took also 4 trading days. So we're right in this ballpark of where we should get ready for another leg down. There's several parts of the market that are extremely weak. The Russell 2000 is just very, very weak. It doesn't have any friends at all. And we're also seeing some divergence in the New York Stock Exchange Index. Again, let's put the IWM up here just to show you how weak it is compared to the to the rest of the market, because we've not really been able to take out the highs of last Friday, which is we've shattered those in the other indices, but not with the S&P. So the Russell is really lagging badly with the rest of the market, as is the Nasdaq. Both of them are, very, very slow. Okay, now. Well, one other thing that I should mention about the stocks is the New York Stock Exchange Index is also made, which is our one that we follow the most, has also made a 61% retracement of the high that we made, way back, in December. But we still have these major divergences that are occurring, and we still think that is the real key to what the market's direction is going to be to the downside. Folks, I don't believe the things that they're doing with this quantitative easing is correct. I know it's a giant experiment started by Mr. Bernanke, but, it's never been tried before. My feeling is, if it was so good, why didn't they try it before? Maybe I'm wrong, but, like they say, someone's got to ask some questions about it. But they don't allow that here in the neighborhoods where we live in Tucson. You have to pay your bills. You don't get flooded with money just because someone wants to print some more. We don't do that here in the western United States. We're little old cowboys. We have to go out and rustle cattle to get our money. Okay, now we're going to talk a little bit about gold, because we've had a nice move here. We're having a pretty nice move in some of these things, which are nice. We'll start out with this gold silver weekly. We've been talking a little bit about this over the past few weeks, because it did make a double bottom down in this area. We've had a nice rally of about 20%, almost 35% now in the XAU over a period of about 10 weeks, and we're completing an ABCD pattern in that level. Now, at the same time, when we were watching this before, we were watching the weekly platinum chart, because platinum, also being a precious metal, also stopped at the exact 61% retracement, and platinum has rallied over $100 an ounce just in the last 4 weeks. So it's had a pretty strong rally through this time. We're having a good rally in silver also. Silver is now approaching the 61% retracement of the whole move that we made from the bottom when we made it 1410 to the high we made back in March. So that's telling us that we are getting probably getting ready for some type of correction in the gold and silver. Doesn't necessarily mean that's going to happen. It just tells us that that's pretty much what we'd like to see. What's interesting about the silver, folks, is silver has not even been able to take out yesterday's high. Now that's not a very good sign when we have gold being as strong as it is. You would think that this would be it's very, very close to the 61% retracement, as you can see on this next chart that we posted here. We need it to get to about 1870 per ounce in the silver, and right now we're only trading at around 1838 per ounce. So we're still in the ballpark, but we're very, very close to hitting that spot. So silver, gold, platinum all still look very bullish, but we need a little bit of a pullback to to be a buyer. We really liked it down at 1170. Now we've rallied the gold, and now we've rallied quite a bit. We're $140 higher, $135 higher than that. So that tells us that we've got I think we have some more to go by looking at this. Now, the other one that I wanted to mention to you here is the gold on the long-term weekly, because we recommended, when we hit this 1160, 1170 area, which was a 61% retracement on the long-term charts, we felt that was going to hold. And so far, that has been the case. It has been able to hold, and we've had this good rally. All we need now, folks, is a move above, I believe, 1340 in the gold. And ideally, it will come after a sell-off. I keep saying that, but, the last time we had these rallies, they were a little over $100. Just like we had in the S&P just recently, we had these same types of rallies in the gold market over a weekly basis. We had one in early 2013. That was a pretty big move, Then we had another one in the early 2014. That was equal to the same rally that we had now, and we're almost at the same point. That comes in at 1311, would equal the same rally. In other words, last three of these rallies over the past 2 years have all been the same amount, $135 per ounce. So there's a lot of repetition that is happening in this market. So it's important to, to really pay attention to it from a trading standpoint, because you've got a really good spot to look at it. We were able to take out the highs of yesterday in gold. We haven't done that yet in silver. So that would tell us that possibly, this might be the spot where we're getting ready to have some type of a correction to the downside. The overall markets across the world today, I guess, were all rallying. They all sold off quite a bit into the news announcement from the ECB. Then all the markets turned and rallied really strongly. They didn't keep going up. They stopped the course and backed off, but at least they started, in the right direction if you're bullish. I don't think that these things are going to help anything, because I just don't know how they're going to unwind this, and it just doesn't make economic sense to me that this could really be an event that's going to make anything of any significance to the economy. I mean, that's the way I see it. And maybe I'm just an old fuddy-duddy. Well, we already know that. But the question is whether this is going to be an interesting phenomenon when we finally finish it up 3, 4, 5, 6 years later, and the history books go back and tell us what really was happening. Wow. I see that there's been a lot of charts posted by accident, which I'm very sorry about. And we're going to post the chart for crude oil. It's an hourly chart going back over the last 2 weeks. As you can see, we had a pretty good rally from 44 up to 51, which was $7. That equaled the rally that we had back in July. Since that time, the market has backed off. And what's interesting about it is the other times that we've done this, we immediately went down into new low ground. And now what we're doing is we're approaching the 786 of the contract low, which came in at 44.22 back on the 13th of January. Now, if that low holds and we don't go below that, we've got a chance here for the first time in a long time for crude oil to rally. Now, I know it seems like it's strange that it could rally, but the whole world is just about totally convinced that crude oil is dead forever. And the one thing we know about that commodity is that it swings. It went from $10 back in 1991 to 143 back in 07, all the way back down to 30, all the way up to 109. And now we're back to 40, and they're talking about the death of it, which is usually the wrong thing to do. So we'll keep an eye on this. Got to take a little break here. We've got the Dow up. Gold is hanging in there pretty good. And the rest of the market is trading nicely.
How would you feel if you had a powerful decision-making tool that has the ability to find high-probability trading opportunities across multiple time frames in equities, currencies, and futures? Search no more. Take advantage of the best trade with the TAS Profile Scanner. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to help them make the best and most accurate decisions. Scan over 1,000 equities, currencies, and futures instruments for high-probability trading setups utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time, for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. Subscribers will also gain access to the December 9th workshop with John Logan. There's no obligation to pay anything. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Futures Hour.
We are going to be talking about the currencies here for this next little bit of time that we have before the break, and then we'll have Ed Carlson on at the break from the Seattle Market Technicians Association, and he's always an interesting guest. We're making new lows now on the weekly basis in the euro. We're only about 150 pips away from the long-term 61% retracement going back to 2000. That's going to be a very, very interesting spot because that's when the euro actually traded at 80. I remember that because my grandson was born just about the time that the euro was making its all-time low. And it took off. Of course, it really started, in 99. They started putting out the currencies and stuff. But in 2000 is when the introduction was really forthcoming, as I recall. And it went from 80 all the way up to 160, which happened in 2007. And now we've reversed that. And we're coming into a 61% retracement of that move. One of the things that W.D. Gann worked on in his life, and he was a 33rd degree Mason. He also knew all the things about sacred geometry because he went to Egypt and studied the pyramids, but the squaring of price and time. And if you take the low that we had back in 2000 and you bring it forward to the high we made in late 2007, if you connect that high to the low that we're coming in now, this all squares out. this month. January, early February brings this an equal move. In other words, the equal move up from 2000 to 2007 is an equal move down between 2007 and 2015, coming in very, very close, and we're almost breaking 114 right now, so that puts us just about 150 pips away. And since it's moving about 150 pips a day, it wouldn't take more than Friday or Monday, and we could be looking at this 1.256, which is the 61% retracement of the euro on the long-term basis. So this is what it appears to be happening. I don't see any reason why that target's not going to be hit. We have several ABCDs in there at the same time. So this will be a very interesting price level to hit in the euro at 1.256 in the euro. So we're 150 pips away, which isn't too bad. I mean, it's been coming down very nicely. Trades actively. Today we had a 200 pip rally before the a news announcement by Mario Draghi, the chairman of the ECB, and then the market, gave it all back, plus another 60 pips. So the trend is certainly still down, but we're really coming close to this number, folks. This is a major Gartley pattern, squaring of price and time. A lot of things saying that we should find some pretty good support at this 112, 113 level in the euro versus the U.S. dollar. Remember, the euro versus the U.S. dollar is 53% of the weight of the dollar index. So that's going to be another factor that you must think about, because when you're looking at that dollar index, 53% of that index is the U.S. dollar. So that's a factor that should be factored in when you're looking at the basket of currencies. But, the dollar is still out there. People, even though it's gotten hit pretty hard through here, people still like it quite a bit. But history is going to tell us whether that's going to remain to be seen or not over a long period of time. Whether the question that someone's just posed me is what will be the effects of gold versus what's happening to the euro? Well, folks, the euro has been going down since last February. It's almost 12 months now. Gold has been coming down since July very strongly. We bottomed in November. So it's hard to take an analogy between the two, in my opinion. I know that as the price drops, you can buy more gold because the price of the euro is less than $1. But frankly, that doesn't, happen too often. So we'll have to keep that in mind when we're watching some of these. I've always felt that the only way to trade these markets is to look at each one of them separately, so that you don't get too confused over, what's really happening with it. That's what I would suggest you do. Now, I'd like to take a minute here before we come to, we're going to be coming to the break pretty quick with Ed Carlson, but hopefully towards the end of the show, I want to be able to put in the chart for the Treasury bonds and Treasury notes to show you what's happened in that market on this very wild day that we've had in the currencies. So we got a break coming. I guess it's almost time. They've got the Dow is still pretty strong, up almost 80, 90 points. We've got crude oil trying to make a bottom down at the fact it just hit that 786 level at 46.10. That might be it, folks. We've already rallied a little. 877-927-6648.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, folks, we have our guest, Mr. Ed Carlson from Seattle, the home of the second-place team for the Super Bowl this year. I'm just teasing you, Ed. I'm a Patriots fan, and I just hope they don't hurt you too bad up there. That's the only thing I'm thinking of is that, you know, I don't want it to be 52-0 or anything like that, but maybe you'll make a good showing, huh?
Yeah, I think the Broncos felt the same way last year.
Indeed. Listen, I posted your first chart up that goes back to the year I was born, 1940. So tell us what you're seeing here. Most of the folks here, you know what we should do, Ed, is give us a little background of your work with George Lindsay, and you know, you've done so much that just focus on the Lindsay work, I believe, and what you're doing now, and how folks can reach you, and then you can go into your program.
Oh, well, all right. Thanks, Larry. Yeah, I've been working on trying to rediscover the work of a lost master from back in the 1960s, 50s, 60s, and 70s by the name of George Lindsay. Lindsay wrote a newsletter for, 35 years, but he never wrote a book on his methods, and consequently, a lot of those methods were disappearing to history when I discovered him as a footnote in more than one book. And so I started digging into it and was able to recover a fair amount of information. And then once I got the word out in late 2010 that I was writing a book. Fortunately, a lot of people around the world who had somehow managed to sit on some of his old newsletters all those years, they forwarded that information to me. And as of today, there's 3 books on Lindsay's methods, and I'm working on a 4th and, knock on wood, final book. Lindsay's work is very unusual. It's like nothing else anyone has ever seen, even if they've been a real student of technical analysis. And he's appeared on, he made 2 appearances actually on the television program Wall Street Week with Louis Rukeyser. I don't know if any of your listeners
I remember that. Sure. I certainly remember Lou, and I remember him being on the show.
Oh, okay. And actually, there's a clip of that at the website, seattletechnicaladvisors.com, if anybody wants to watch it. It's very short. It's his 1981 appearance. And he was an unusual character. He passed away in 1987. But on that program, that clip, it shows him predicting a year in advance the end of the bear market. That was in 1981, and he said it would come about a year later, and he was within 2 weeks of that call. And then in July of 1987, he wasn't writing his newsletter regularly anymore, but he was still getting published occasionally. And he wrote a letter to John Brown, who had his own newsletter in Houston and would publish Lindsay's comments occasionally. And he wrote a letter saying that he felt like the bull market would be over in August of that year. And sure enough,
he actually
August 25th, I believe.
That was the day he passed away. I remember reading his obituary, and I've kept it. And that was the day he passed away, was August the 25th, when we had harmonic convergence, But how will folks reach you if they have interest? What's the best way to reach you, Ed?
Oh, sure. The best way to reach me, the easiest, is just go to the website. Again, that's seattletechnicaladvisors.com, and you'll find a Contact Us page. And as a matter of fact, before I forget, I'll just make everybody an offer. If you do contact me through the website today before the market closes, I would be very happy to send anybody who identifies themselves as a listener of your program a free copy of the January Lindsay report. And
that's a good deal.
You an idea as to what. Free is always a good deal.
That's always a good price. Yeah, I can even cover that.
Okay, good.
Okay, you want to go on to chart number 1 now and tell us what you're looking at here?
Yeah. As a matter of fact, I probably should say we're going to start with some non-Lindsay work. This is traditional cycle analysis. What we're seeing here is a 7-year cycle that has existed for many decades, and it has done an excellent job of calling highs in the market. Now, as you look at the chart, you'll see that some of those highs are more significant than others, but most of them were the type of preceded the type of downtrends that you really didn't want to ride out. And given that the last 7-year top was in October of 2007, well, we're actually we're a little on the late side right now. That doesn't mean we've missed it. It just means that any cycle that's 7 years in length isn't going to come exactly on the exact date. And so that's the first piece of evidence I wanted to share, giving a reason why I think we're probably looking at a significant decline coming up. We've got a 7-year cycle high that is trying to push the market down.
Mm-hmm.
So then if you can go on to the next chart, it's a 4-year cycle. I don't know if I should wait till you get that up or.
It should be up now. It takes a little bit of time because of the going into it, but it's in there now. I'm pretty sure. I can see it myself, so I guess it's okay.
Oh, I see it. Sure enough.
Yeah. It just
okay.
You're a little slower up there in Seattle, Ed. You know that.
Oh, it's the internet.
I have too many friends in Seattle that are giving me a hard time. So.
This is a 4-year cycle, which has marked lows, for a long time. This one is interesting. This is I'll give you a little background on it. Anybody that's taking the time to look closely at this chart is going to notice not a low, but rather a high in 2007. Now, the last time this cycle inverted like this was in 1946. And in 1946, we were coming out of World War II, of course, and the Fed was, in order to prevent a relapse into the Depression, was in the bond market actively. That might sound familiar to a few people.
Oh, wow.
And, and they had literally bought up the entire supply of T-bills in the American bond market. So, excuse me. So, of course, that's similar to today, except that, of course, the Fed is buying longer-dated, long maturity debt. So it's just another example of Mark Twain's old saying, history doesn't repeat, but it rhymes. And so I thought that was interesting. So anyway, the point of the chart, sharing the chart, is that not only do we have a 7-year cycle high pushing the market down, but we also have, in 2015, a 4-year cycle pulling the market down. And so we look for a 4-year cycle low at some point during this year. Mm-hmm. And with that, we can move on to the next chart.
Okay. I've got her up there right now. This is the one that goes back from 1992, correct?
Right. Now, this is, now we're getting into some of Lindsay's work. And this is called the 22-year overlay. Lindsay explained this pattern or model in a two-part installment of his newsletter back in 1964, I believe. And in it, he shared 18 different examples of how this thing had worked. And what we're looking at here is a template which includes a 22-year interval from low to high, a 15-year interval from low to high, and an 8-year interval from low to high. And as you can see on the chart, it's not exact, 22 years and 3 months until today from the low in 1992, 16 years and 3 months, excuse me, got a dry throat this morning, 16 years and 3 months, which doesn't sound like a 15-year interval, but Lindsay's 15-year interval actually stretched from 15 years to 15 years and 11 months. So running a little long here to the December 26th high in the Dow, and then there's an 8-year interval. Well, as I said, Lindsay showed 18 different examples between, the beginning of the Dow in 1897, I believe, to when he wrote that in 1964. And it's to help time market tops. Now, not all the market tops that it points to are significant, but for the most part, you wouldn't want to be in the market during the pullback that follows these things. The reason I'm sharing this today is not just to show that we've got one more item pointing to a top here, but rather to give us some insight into 2015. Let me grab a quick sip here. And here's what I mean. Lindsay wrote that his 8-year interval is usually followed by a 2 to 3 month fairly drastic decline. And once that decline is over, that is then followed by approximately 5-month rally. Okay? Well, if the top was made at the end of December, then a 3-month decline, of course, would be March. So with that, let's go to the next chart.
Okay, this would be number 4 with the 14 interval?
Yes, right,
okay.
Right. This is a 14-month cycle low, which since the low in 2009 has been just almost spooky in how well it's timed the lows. You can see prior to that, it fluctuated a little bit. Hurting here. Sorry, Larry.
Next time we're going to do this in a hospital for you, Ed.
Thank you. I'm going to have to switch to menthol.
That's okay.
And this 14-month cycle low points to a low in March. Well, like Lindsay said, after an 8-year cycle high, you expect a downturn of 2 to 3 months, which is March of 2015. Also, just parenthetically, I didn't send you this chart, but there is a 21-week cycle low, which is also due in about mid-March. And I would remind listeners that these cycles are not exact. They can fluctuate, as you can see in all the charts I'm sharing today. But it gives us a pretty good estimate on where the market's headed now, which, despite today's ECB reaction, is probably still down. Okay, so bottom line, looking for a drop into March of this year.
What was the date that you had? Because I know they're going to put your feet to the fire on that one.
The exact date?
Yeah. Is around the 22nd, around the equinox?
Oh, well, that I honestly haven't got to that yet, but
okay.
That would make a lot of sense, Larry. The 21-week cycle low is due the week of, I want to say March 18th. I'm not even sure if that's
close enough. It's been 4 or 5 days, yeah.
Yeah, that's real. That's actually a Wednesday, and the equinox is on the following Saturday, I guess. Okay, so then let's go on to the next chart. There's been a lot of talk.
Seattle election years?
Yeah, pre-election years.
Yeah, okay.
There's been a lot of talk about this year being a pre-election year and also year 5 in the decennial cycle. Well, the reason there's so much talk about that is because these are typically very bullish years. As a matter of fact, there has not been a down pre-election year since 1939. And so what this chart is, this is a seasonal chart of all pre-election years since then. And you can see it actually looks pretty bullish. You don't see any downturn into March with this one, not on average. However, let's say we do get that low in March that I'm looking for. If we get a 5-month rally following that, that matches up with that high you see in early September on this seasonal chart. And so once again, it seems like it's all kind of coming together. A low in March, followed by a summer rally, and then you get the top that you almost always see in September, regardless of whether it's a pre-election year or not, frankly. So I guess the only question that leaves is, well, will the year actually end higher than it started or not? And while it's really tough to fight the track record of these pre-election years and years ending in 5, see some really good reasons from Lindsay's work that we really should not expect a higher high by the end of the year. And that's pretty much what I had to share. So I guess I'm open to any questions you might have.
Well, what we'll do is when we come closer to that March, maybe we'll have you on again. And especially if you're right. If you're wrong, we might never hear from you again, of course. But
right.
No, we're always, it's probability. But I want you to take care of yourself. You've got this terrible flu that we've got going around. So just make sure that you, when that ambulance pulls up, that you get in, okay?
Well, no problem. And actually, I hadn't even put 2 and 2 together. My wife's been in bed for the last 3 days, so maybe I am starting to catch it. It's a good thing you got me on before I died, Larry.
Yeah. Listen, thanks for showing up and helping us out, and we'll have you in soon, and folks know how to reach you, so hopefully they'll follow through with what Mr. Lindsay was looking at.
And don't forget that free report. Anybody that contacts me through the website before the market closes today, I'm more than happy to send them a copy.
Okay, thanks a lot, Ed.
Thank you, Larry. Have a good one.
You bet.
Bye-bye.
Okay, that was Ed Carlson of the Market Technicians Association of Seattle. We got to take a break here. Stock's still strong, gold's still up on the day, and bonds are weakening.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN. Now, back to the Futures Hour.
Okay, we're back, folks, and we just had Ed Carlson of the Seattle Market Technicians on. And if you want a free copy of his letter, all you have to do is contact him by the end of business today, and he'll be happy to look at it. Upcoming shows, probably in the next few weeks, I'm going to have Bill Meridian, also known as Bill Cerubi. He goes by the pen name of Bill Meridian. Bill has been a friend of mine for over 40 years. He's a financial astrologer. He worked for 15 years in Abu Dhabi, where he was working for the Saudis in part of their investment community. He basically worked with the stock market and also with gold and silver. He retired and lives in Vienna, Austria now with his wife, Surya, and he's a really smart dude. Let me tell you, this boy's got lots of smarts. He builds, in his part-time hobby, he builds these games that the people play on the computer. I forget what they call these things, Modern Warrior, whatever they are. But, he's studied history with battles and stuff, so he's got a lot of experience with military things, and they convert that into the game theory. But his main passion, of course, is the market, and he's a very good friend of Arch Crawford. And so we'll have Bill on sometime in the next couple of weeks here, and hopefully we'll have him on more than once, because he certainly has a great deal of experience, and a level of his knowledge is, especially in cycles. He owns a a firm called Cycles Research, and we'll have him on to talk about some of these things. So we'll have Bill Meridian on sometime in the next few weeks for sure. Okay, now the next chart we want to talk about here is the Treasury notes. This is the long-term weekly chart. Now remember, folks, we have negative interest rates in Germany, Japan, India, and also in, where's the other one? Germany. One other country has got, is it Switzerland? Well, there are 4 major countries now that have negative interest rates. So that's a good deal for somebody. It's certainly not a good deal for me, but that's what we see going on here with the interest rate market. The ECB is going to do their version of quantitative easing, and I want to wish him the best of luck with that, because I think history is going to go back and say, I don't think this is going to work the way you think it's going to work. The other thing that I wanted to mention is that we have a really strong probability of crude oil bottoming today, because we're testing that 786 with very, very bad numbers. And when a market, it's still down quite a bit, but it hasn't collapsed, which usually it collapses on those types of numbers. But this could be a good sign, the fact that it hit the 786 retracement, and that would make it, a very interesting play, because we've only had a $7 rally since July. We just had one from 44 to 51, but I think we've got a chance. And the reason why I say that is it's universal that oil is dead in the water. That has no chance of rallying. I mean, when you listen to CNBC or Bloomberg and you listen to people coming on the air here, I mean, they just think it's that if you get a 50-cent rally in crude oil, it's almost a surprise. But this would be the time where you'd get $20 or $30 rally for some unknown reason. But the whole world is definitely on the short side of the market, as they should be, because the trend is down. But the pattern is holding at the 786. As long as we can stay above this 45.50 level in the crude oil per barrel basis, the March contract, I think we have a chance of seeing to make it work. One of the questions that someone had about Ed Carlson's work was how it relates to the Bradley model, and we are looking at a March low around the 22nd near the equinox. So that's it, folks. Live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.